Alright, economic policy. Um, Basically what you need to know for economic policy for the test. This is just kind of the intro. Adam Smith wrote The Wealth of Nations. This was kind of one of the first books on economics. You should know the term laissez-faire, which is the idea that having the government stay out of the economy is the idea of laissez-faire, much like the monopolists did the government did under the age of the monopolists. The Interstate Commerce Act basically regulated railroads and created the Interstate Commerce Commission, prevented railroads from charging absurd rates when they had a monopoly over a certain route. And so to fight monopolies, you have the Sherman Antitrust Law, which you guys studied last year, and it basically was trying to fight monopolies. It did not work until the Clayton Antitrust Act was passed, which had more effective methods to prevent monopolies. The Federal Reserve Act created the Federal Reserve, which deals with monetary policy. Monetary policy is the control of interest rates and the money supply. Essentially, when you lower interest rates, the more people borrow money, and so that basically pumps extra money into the economy. What the Federal Reserve Act did was it set up the Federal Reserve Board, which is, even though it doesn't have a commission at the end, it is an independent regulatory commission. The people serve terms of 14 years, and the chairperson serves a term of 6 years. And the chairperson runs the bank, and they, as a group, control the monetary policy of the United States. And they do it independent of Congress and the President. And this keeps politics out of federal monetary policy, and it also allows them as experts to try to have a better policy. Alright, so the monetary tools, they control the discount rate. So essentially the Federal Reserve lends money to other banks. So the Federal Reserve is currently lending money to banks at about a rate of 0.25%, so they're making very little money on their loans. And then the banks turn around and loan money to people at like 4 or 5% mortgages if you have good credit. On the other hand, if the Federal Reserve decides to raise the rates, this will, let's say they loan money to banks at 4%, then they'll turn around and start loaning, the banks will turn around and start loaning money to people at 8, 9% if they have good credit. So this is basically has a way of raising and lowering the interest rate. It is an incredibly powerful tool and is frequently used to manage the economy. Unlike the budget, which the Congress and President control. The 16th Amendment basically made income taxes illegal because they were not legal according to the founders. And the income tax is basically how the government gets most of their money. It is a tax on people's income. We mentioned the Clayton Act earlier. That was basically strengthened the Sherman Antitrust Act. Alright, so during the Depression we had the Glass-Steagall Act, and basically this created the Federal Deposit Insurance Corporation, the FDIC. And what it did was, the FDIC is, in fact, when you go to your bank, there's frequently a sticker that says FDIC insured. And what that means is that your deposit is insured by the bank. So if the bank collapses and you have $10,000 in the bank, it insures your money and you get your $10,000 back from the FDIC. If, on the other hand, you had $1 million in the bank, you only get $250,000 back, because that is the maximum they insure up to. So you can get up to $250,000 back, and the whole point of this was to restore faith in the federal banking system. So, for example, in 2008, when the economy kind of collapsed, there were a number of banks that failed, and yet there was not a panic or a run on banks because people knew that their deposits were insured, and so there was no panic. You didn't have news agencies screaming that the banks are failing. Instead, people sat there and then a government agency came in, the Federal Deposit Insurance Corporation, and they went into those banks, they analyzed where the money was, and they insured the remainder of the money back to the people. Alright, so as you can see, these are all kind of Depression-era programs if you look at the dates, the 1930s. So the Securities Act essentially was to combat the stock market crash, and it basically said that investors had to be given full information about the stocks that they were purchasing. This is much of the reason why stock companies today send home, newsletters to people who own stock to let them know what has happened in the stock. There's still ways around these rules, but the idea is that people with more information make better decisions. It doesn't always work out that way, but that's the theory. Of course, we've already discussed Social Security, and that was passed in 1935 and basically sets aside money for the elderly. So we are all paying taxes, or when you have a job, you are paying taxes, an entitlement tax, back that then is going to the elderly after they retire at age 65. And then there's the Securities Exchange Act, which created the SEC, which is the Securities and Exchange Commission, and they regulate the stock market. And by regulating the stock market, they're basically trying to make sure that stockbrokers are not cheating people out of their money. So when mortgage brokers were passing out bad loans to people in 2007 and 2008, and when the market collapsed because they combined those mortgage payments into something called a derivative, and those derivatives they told people that they had AAA rating even though that they were really no good and very risky. The people thought that they were not risky, and the SEC should have regulated that and paid more attention. They did not. They were asleep at the wheel. But that is their role, to regulate deceptive practices in the stock market. Alright, and so the 30s continue, and we can see that labor starts to get the things that they are worried about, in the late 1800s and early 1900s, which is the minimum wage. Today, I believe it is $7.25, and it is illegal to get paid below the minimum wage. The TaftHartley Act did something very important, and basically it was passed in 1947, and it kind of reined in the power of labor unions. Labor got a lot of what it wanted during the 1930s, and so the Taft-Hartley Act said that you could not force employees to join a union. That instead, let me just correct that because that's irritating me. Instead, federal employees, and on top of that, federal employees could not strike, and the president could place an 80-day injunction against a striking group if it goes against the national health or safety of the United States. For example, in the 90s, there were a lot of strikes against that airline pilots, because they retired, they didn't want to lose money, or they didn't feel like they were earning enough. They went on strike, and President Clinton issued injunctions to prevent those strikes from going into place because they would weaken the U.S. economy. Alright. The Taft-Hartley Act, and then let's go to the next slide, and then I'll come back and explain this idea. And basically, the other thing it did was it created something called a union. Well, there's already a union shop. A union shop is the same thing as a closed shop. A closed shop means that you have to be hired. You have to join a union to get a job. So you can get hired, but then you're required to join a union. So, for example, in New York City, if you are a teacher, you have to be a member of a union. Whereas Virginia is a right-to-work state, which means that you do not have to join a union. Now, this is important because what it means is everyone's required to join a union, the union is more powerful because they're getting more money because everyone has to be a member. With the power of unions, that means that they can demand higher wages, and so it's why New York City teachers have gotten, fight for, their members. In Virginia, it is a right-to-work state, which means essentially that you don't have to join a union. So it could mean that if you have a teacher that is a member of a union, that teacher is paying dues and the union's fighting for a raise. But it could mean that a teacher across the hall isn't a member of a union, and that teacher, the new teacher, also got a raise across the hall. And that is called a free rider, meaning that the non-union teacher was able to take the advantage of the union teacher because they got the raise and didn't have to join the union. Alright, well, we've discussed supply-side economics in class, and we also discussed Keynesian economics. The short answer is that supply-side economics, or Reaganomics, also known as trickle-down, is simply cutting taxes, and it also involves cutting regulations. If you listen to the Republican candidates, that is what they're saying that they will do to fix the economy. If they cut taxes, then the wealthy will have more money. If the wealthy have more money, they will invest it into their companies. They will pay more people and be able to hire more people to do more work, and the economy will improve. And if you cut down regulations, same idea. It's not necessarily a part of supply side, but it often goes hand in hand. Demand side, or Keynesian economics, is simply that when there is a recession, the government should spend more money. They should borrow money, much like Obama tried to do in 2009 when they passed an economic stimulus bill. And they borrowed $800 billion to stimulate the economy. The Democrats claim that that worked, and by work they mean that they prevented a complete disaster or a second Great Depression. Both of these are economic theories, and the Republicans favor supply side and the Democrats favor Keynesian economics. Alright, we are almost done here. The Budget and Empowerment Act of 1974 basically set the size of... Basically what it did is it created the system in which we pass a budget. So this might be a useful act to look at when you're writing your essays. It also established the Congressional Budget Office, which basically audits the federal government and makes sure that they are basically can analyze the president's budget to make sure that it is correct. The Gramm-Rudman-Hollings Act was passed in 1985. It was to reduce deficit. Basically, the goal was to get down to no deficit and run close to a surplus. And it basically was to create, if they didn't make the goal, they had to have across-the-board cuts, except for Social Security, Medicaid, veterans benefits, food stamps, and temporary assistance for needy families, which is what welfare reform was. What that meant was that if they didn't agree on the budget, they would have automatic cuts. This never happened because under Bill Clinton, the Democrats raised taxes, and this provided more money for the government, and they ran a surplus in this time period. So the Gramm-Rudman-Hollings Act was just wasn't that significant. And finally, there was a budget crisis in 1995 and 96 between Newt Gingrich and Clinton. In that, essentially, Newt Gingrich, they could not agree to pass a budget, and so the federal government closed for, I think, 10 days. And in that time period, the Republicans were blamed in particular by the media for shutting the government down. And as a result, Gingrich capitulated, meaning he surrendered to Clinton. If we look at the Tea Party today, they are angry with Gingrich still over the fact that he surrendered to Clinton so easily. They felt that if Gingrich had held out longer, that they would have gotten the deal they wanted. And this is why you see the Tea Party today refusing to compromise with the Obama administration, because basically they think they can get a better deal if they hold out. And to be honest, frequently the longer you hold out and the angrier you get, and the more you're willing to threaten a system, you definitely do better. Anyway, so hope you guys feel a little more ready for the test, and see you tomorrow.